Welcome to the Market Mosaic, where every week we are breaking down macroeconomic data and looking at the stock market's technicals and market internals, things like breadth and sentiment, to figure out where the market could be heading over the near term. And look, the Federal Reserve remains the primary catalyst for driving the stock market right now. So I want to get it down into the different things that we're hearing from the Fed, some of the conflicting views that's starting to really cause some confusion among investors. Because look, it's only 1 week following the Fed's first rate cut in 9 months, and we're already seeing uncertainty rise over the pace and magnitude of further cuts. And that's because in a speech last week, Fed Chair Jerome Powell, he made this comment. He said there's no risk-free path for the Fed given challenges to both the labor market, where we've been seeing some weakness, and ongoing inflation concerns. We'll talk about inflation, how it remains well above the Fed's 2% target. But Powell also said this. He said that interest rates are in a good place to deal with either threat. And to me, that makes it sound like the Fed will not lower rates much pending further incoming data both on both mandates, the labor market and inflation. And so his comments seem to signal yet again another Fed pivot on which mandate, inflation or jobs, which mandate they view as more important. So in Jackson Hole in August, at his Jackson Hole speech, Powell signaled that the labor market was the greater focus. But before that, at the end of the Fed's July rate setting meeting, the bigger risk, according to officials, according to the minutes from that meeting, the bigger risk was upside to inflation. But here again, we're seeing this pivot. And so after Powell's comments, markets are again repricing the outlook for rate cuts. This chart on here shows the 2-year Treasury yield. Why is this important? That black line, the 2-year Treasury yield, this tends to lead changes in the short-term Fed funds rate. So the 2-year yield, you can see right here, starting to rise a little bit since the Fed's last meeting. And if you look at where the effective Fed funds rate is at, so this is the upper bounds of their range, but if you look at where it's currently trading at, the 2-year yield is only about 50 basis points, 0.5% below where effective Fed funds is at. That implies only 2 rate cuts looking ahead in total, not just this year, but 2 rate cuts in total. And so you're seeing the markets reprice that outlook here. Again, you can see this black line tends to lead changes in the Fed funds rate, stop rising well ahead of Fed funds. That flagged the pause on rates, and then the subsequent drop below Fed funds led the Fed to cutting rates. And now we're back at a spot where right now the 2-year Treasury yield is only implying about 2 rate cuts looking ahead. Here's the other thing. It is not helping the argument for easy monetary policy when economic data is holding up so well. Gross domestic product for the second quarter was revised to an annualized rate of 3.8%. While inflation did not surprise to the upside, the PCE, the Personal Consumption Index, Expenditures Index, was up 2.9% in August compared to last year. That's on the price index. That's the Fed's preferred inflation gauge, and core inflation remains well above the Fed's 2% target. Now, there is some areas in the market where we're starting to see this way. Rate-sensitive growth stocks are pulling back. And that's because investors are coming to terms with fewer rate cuts. So those high growth stocks, a lot of times they have very little by way of revenues and negative earnings. Those stocks are very sensitive to the outlook for interest rates. But here's the good news. Stock prices, they ultimately follow at a high level. Stock prices ultimately follow corporate earnings over the long term. And this positive economic growth pulse that we're seeing is good for that earnings outlook. And if anything, even if the Fed is forced to slow the pace and magnitude of rate cuts, financial conditions are already running loose. The Fed didn't need to do anything. Financial conditions are already loose, and that means a credit backdrop is supportive for the economy. So in this week, I want to look at additional evidence that the economy is actually accelerating. This is a huge challenge to the conventional wisdom on how the economy is doing right now. I think it's accelerating, and there's conditions in place to support that growth looking ahead. I also want to look at the potential for volatility, at least over the near term, as investors come to terms with this new rate outlook. But first, let's start with the economy. The revised second quarter GDP report showed the economy growing at an annualized rate of 3.8%. That challenges the widely accepted view that the economy is struggling. The revision, and here's the thing, this revision, it mostly reflected stronger growth in consumer spending. This is where we have a huge disconnect. Survey-based indicators, so consumer sentiment surveys, points to a gloomy consumer, but the data is showing anything but that. The most recent report on August retail sales, that gained 0.6% month over month. That was better than expected. And as these strong consumer spending figures continue to come in, that is propping up current quarter GDP growth estimates. So the Atlanta Fed has a popular estimate. It's called the GDP Now model. And that right now, as I'm recording this, is pointing to 3.9% annualized growth for the third quarter. So we're coming off 2Q, 3.8% growth. This is now saying third quarter is running at 3.9% annualized. Look, the economy is doing amazing. And a big driver of that estimate is this dark blue bar on here. So you can see this time series. This is the time series of how this estimate has evolved going back to July, again, for the third quarter. This line on here is the total forecast, taking all these subcomponents into account. And this dark blue bar is consumer spending. Consumer spending is the vast majority of GDP, vast majority of the economy. And you can see, especially since September, it had shrunk a little bit. Since September, we're seeing an expansion in that dark blue bar, pointing to a pickup in consumer spending, which is helping fuel this estimate. At a time when the economy is showing signs of accelerating on the back of consumer spending, we have another tailwind, and that's with credit growth. Credit growth is emerging as another catalyst to support economic activity. So the chart on here, this shows the year-over-year change in U.S. bank lending. So this green line on here is the year-over-year rate of change in U.S. bank lending. These shaded areas are recessions. This goes all the way back to 1950. But let's just look at recent years. In recent years, lending activity took a hit and dropped. You can see the rate of change dropped below zero. That coincided with the Fed starting to raise rates in 2022 when inflation was running extremely high. But once the Fed started cutting rates again late last year, you can see this line on here started to rebound, okay? And then with the Fed restarting this cutting cycle, they've been on hold for 9 months. Now they're restarting this cutting cycle. That could be another catalyst to keep driving bank lending higher right here. That would support ongoing loose financial conditions. So keep an eye on bank lending as another tailwind for the economy right here. Although the outlook for the total number of rate cuts by the Fed is in question. Look, a global easing campaign around the world is already and has been underway. And here's the thing, it is rivaling some of the broadest rate cutting episodes we have ever seen. So what this chart shows is the cumulative total rate cuts by central banks around the world on a trailing 12-month basis. So how many times over a trailing 12-month basis have central banks around the world cut rates? The number of rate cuts right now at 168. That is approaching levels seen coming out of the pandemic in June of 2020. The only other period besides those two that experienced a larger number of rate cuts came following the 2008 financial crisis. So in October 2009, as the central banks were scurrying to prop up the economy back then. So this is just absolutely crazy that you have this number of rate cuts at a time when the economy has already been expanding for a couple of years. There's evidence that growth is actually picking up, and yet we still have this total number of rate cuts rivaling periods when the economy was coming out of crisis. So this is just more fuel for the economy, more fuel for the stock market rally. So while the Fed is rejoining the global rate cutting cycle that's underway, they've been on hold for 9 months. There's some questions over how far they could go, and that's because of challenges to the inflation outlook that could ultimately limit the magnitude and the pace of rate cuts. And so we had the August PCE inflation report, so the personal consumption expenditures price index, mouthful to say. Well, that's a PCE inflation report. That's the Fed's preferred gauge. And it's starting to accelerate again, following the disinflation trend. So we had the peak in inflation, or this last inflation wave that lasted into mid-2022. Disinflation means you still have a positive rate of change in inflation, but at a smaller magnitude. So this is that disinflation trend. But you can see we've been stalled out around this 3% level for some time now. What you want to pay attention to is this dark blue line on here. This is the year-over-year rate of change in the PCE price index by month. Some of these other lines show more recent annualized figures. But just I'd pay attention to this dark blue line and look at how it's starting to accelerate again right here. So we're starting to see this pick up in recent months, and it remains well above the Fed's 2% target. That's what this yellow line on here shows, that target. So we've never, even though the Fed's has cut rates and is starting to cut rates again, PCE inflation never got down to the Fed's target. And If we see inflation continuing to pick up, the Fed may be forced to reverse course and start tightening policy once again. I think that's something to really keep an eye on as we get into next year. Inflation is going to be slow to change. It's kind of like trying to change direction on the Titanic. It's slow to change directions. Now we're starting to see it pick up. It's low enough that maybe it gives the Fed room a couple more opportunities to cut rates. But if this starts picking up in the next year, that will be a limiting factor. All right, last week the S&P did something it hasn't done in a while. It went on a 3-day losing streak. It hasn't done that since March. But the pullback, really, it was pretty shallow. The S&P remains well above key moving averages, like the 50-day moving average points to the uptrend still being intact. And stocks have mostly avoided a period of seasonal weakness that tends to hit during September. So September, known for seasonal weakness, that tends to be back half loaded. And again, we saw that 3-day sell-off last week, but it's hard to really even call that a sell-off. It wasn't that large in terms of magnitude. But I would not say that investors are out of the woods yet. And that's because of October's reputation to see some volatility return. And we definitely have the catalyst while the growth outlook's holding up. We've got this catalyst of the Fed and how markets are repricing the outlook for rate cuts. That could especially weigh on growth stocks. Growth stocks are more sensitive to that rate outlook, and that's important because some of the biggest tech and growth names out there are driving a record concentration in the major indexes. So the top 10 stocks in the S&P 500 account for 40% of the index. Now here's what we need to watch. From a calendar perspective, October has a reputation for seeing volatility return. So this chart on here is showing the average volatility by month. That is the percentage above and below all the other months on average. And so what you can see on here is that average volatility in October is about 33% above the average relative to the other 11 months. And so clearly, by far, the most volatile month out there when looking at it through that lens. So being on the lookout for this, we had some short-term downside moves in the S&P last week. Watch for this to continue into October, especially if the market is repricing the outlook for rate cuts. All right, so we got, as you can see, a very busy week ahead for data. We're going to get a lot of looks at different measures of how different segments of the economy are doing. The thing that I would be paying, a couple of things I would be paying most closest attention to. One is these manufacturing PMIs. Or these PMIs covering manufacturing and services sector. So you got the manufacturing PMI. You can watch the ISM has their figure coming out as well. This one's probably the S&P Global's figure. Then we've got the ISM. 2 things to watch for in here. Actually, 3 things to watch for in here. Watch for the underlying components. Look at new orders. You're going to see new orders above 50. We'll look at the prices paid index. That's a leading indicator of inflation. See if the prices paid index is still holding at high levels as it has in recent months, or if it's starting to roll over. And then also watch the inventories component. When you get a big spread between new orders being above 50 and inventories being below 50, that can be a positive sign for economic activity. And then also the big one we'll get next week is this non-farm payrolls report. We'll see how the labor market is holding up. We've had some really weak numbers in July and August. That was a big reason for the Fed pivot. We'll see if that keeps holding up. But one thing to keep in mind with government data that's coming out is if we do see a government shutdown, if we see a shutdown occur, that would start. The funding runs out for the government on September 30th, so they need to come up with a new spending funding bill that can be agreed upon to extend beyond that date. But if that does happen on September 30th, if we do have a government shutdown, that could impact some of these reports that are set to come out. Namely, one that's really important for the Fed heading into their October meeting is going to be this non-farm payrolls report. So keep a close eye on developments there as well. All right, let's take a look at a couple trade ideas that I want to keep a close eye on for this week. One is with something I would call an AI pick and shovel play, and that is with GE Vernova, which is a nuclear levered name. So AI data center build out is presenting massive demand for energy, which has sparked renewed interest in adding nuclear capacity. So that's where GEV comes into play. And the pattern I want to watch with the stock is this peak we made around 675 back in July. We've just been grinding sideways in a really tight range. And you can see it's actually tightening up even more. So we had this pullback from July into September. We rallied back toward the prior highs, and we've now been trading in this really tight range since then. So one things I want to see is if we do start to see a breakout, initially look for a breakout over 675, a follow through over 700. If we do see that, we want to see it on rising volume. And I'd like to see the RS line, the green line in this chart, at new highs. So this plots the price ratio of GEV against the S&P 500. When this line is rising, that means GEV is outperforming, and vice versa. You want to see strong momentum behind these breakout moves. That increases the chances, the likelihood that the breakout's going to hold. One other chart to keep a close eye on in the week ahead is with broad commodities. You can track a broad commodities index with the GSG ETF. That is the iShares GSCI Commodity Index Trust. And look, this might be the most important chart for the Fed. This might be the most important chart for the rate outlook. And that is because we have been trading in this range since 2022 with higher lows along the way. We keep coming back to test just below this $24 price level. Here's why, and we're close to a breakout. I mean, look at this. It's trading right back at the high end of the range. And why is this important? Well, the last big inflation wave that we had into mid-2022 coincided with a massive rise in commodity prices. So you can see starting in 2020, carrying through into mid-2022, you had this rally in GSG. This is when inflation peaked. This is when inflation peaked in mid-2022 and started to roll over. Okay, so that this peak and pullback coincide with the disinflation trend. If we see a breakout, these commodities will start to show up in inflation figures in the months ahead, and that will present a massive headache for the Fed and the outlook for rate cuts. So just given where we are with GSG in proximity to this resistance level that we're now testing again, keep an eye on that for a breakout. All right, that is all for this